Welcome to another episode of Good Value by Antipodes.
Welcome to another episode of the Good Value podcast. I'm Alison Savas, and today I'm joined by James Rodda, lead portfolio manager of the newly launched Antipodes Global SMIDs Fund. In global equities, the spotlight is almost always on mega caps, and the alpha generation potential of global smalls and mid caps is often overlooked. In this episode, James and I are going to discuss why investors should consider global SMIDs in their portfolio, how Antipodes' industry-led research approach provides an edge in this asset class, and where James is currently finding compelling investment opportunities in the SMID space. Welcome, James.
Hi, Alison.
James, to start, what was the key motivation behind launching the Antipodes Global SMIDs Fund?
Yep, look, we had two key reasons for launching the fund. I think the first one is the investor opportunity. So when we look at multiples and the opportunity set that we see, we just saw fantastic investor opportunity to generate substantial investment returns at the asset class level. And the second one is sort of why we thought we've earned the right to do it. Over the last 10 years, we've had a really strong track record within our long only and long short funds of investing across the small and mid cap spectrum with really strong stock selection and strong alpha contribution. In terms of why does it work well at Antipodes, I think it's the industry research that we do, and that industry research led process that Antipodes focuses on. And so look, the starting point in all our research is to always understand change that's happening at the industry level, be it cyclical, structural, socio-macro change, and then positioning stocks in the portfolio for change with an eye especially to what is underappreciated change or not in the price. So this is really helpful in terms of allowing us to avoid value traps or growth traps, having a key focus on what is changing. Once we've done that broader industry work, what drops out of that is our potential stock ideas and maybe subsectors of industries that are particularly interesting within a broader industry. And these stock ideas that drop out tend to cover, the broad market cap spectrum. And so, as I mentioned before, we have nearly 10 years of history, and the back tests, are very strong for stocks in the market cap range, which is up to $30 billion that the Global Opportunities Fund invests in. You can see sort of the way the research process is structured in Antipodes. We've always been uncovering really interesting alpha generative ideas in that small and mid cap market cap band. And many of the ideas have found their way into the Antipodes portfolios over time, where we've had reasonable exposure. And so the launch of the SMID Fund, the Global Opportunities Fund, now provides a dedicated outlet for these ideas and others that haven't found their way into the main global portfolios.
We know many of our listeners are familiar with Antipodes Global Equity Funds. So why should they be interested in adding exposure to global SMIDs in their portfolios?
I'll start with the first point that I mentioned at the beginning. Valuations are really attractive in global SMID now, and it's also significantly under-researched relative to large caps and mega caps. So this means more opportunities for stock picking alpha, essentially. So starting with valuation, we're at a record discount to large caps now. So if we were to look at large caps, which are a significant part of the ETFs, and it goes back to the reducing correlations for investors in their portfolios, large caps are on 26 times earnings, and SMID caps, and the smallest part of the market, are more like 16, 17 times earnings. So that's a 50% discount. And when we look at that in a global, in historical context, this is the largest dispersion we've seen in 20 years. So it's a great starting point for stock picking. I think people say, well, these larger mega caps have grown more quickly. And it is certainly true for Mag 7, but they're actually part of that large market. They're not the entire market. And when we look at the entire market of large caps, which we sort of put down our cutoffs around 230 billion in market cap, there's actually only a 1.5% growth differential between the small and mid caps, and that's a 10-year number. So we just think the valuation gap for the growth, however which way you look at, is too large. And so Over time, we think that multiple gap will close. Potentially small and mid caps go back to the historical premium, which is empirically researched for many reasons that has historically existed, that would trade at a premium to large caps. We think that gap will close. So either large caps will derate or small and mid caps can re-rate. And, the interesting thing is that small and mid caps are in line with their long-term multiples. So again, that provides some comfort that returns will be in line with long-term multiples in terms of, risk of drawdown and risk of loss of capital. In terms of, and this is particularly true for active managers, the opportunity set is large. So we're talking over 7,500 stocks in the index, and they're just not as well covered as large cap stocks. So give you some stats on that. Around 50% of the companies in that bench aren't covered at all by any brokers of any note. And then 80% have actually thin coverage, which we would describe as less than 5 analysts covering the stock. So that's really interesting from a information asymmetry viewpoint, where we have the time and resources to dedicate to these companies and these industries in terms of finding change. But it becomes even more interesting when you think about it from an industry coverage basis. So again, we love to look at the industry. We think it reduces our risk and increases the chance we get something right, so our upside. And if we think about large industries, or even just compare subsectors of different industries, so in advertising, you'll see a lot of coverage on social media or search. In broader media, even TV, something in TV is something that does get a lot of notice, but you won't see much on TV operating systems. In travel, you'll see a lot on the leisure market. You'll see a little bit on corporate travel, which is actually quite important, but it's actually starts to get much harder. And then we own a few companies in the corporate travel software and technology space where, again, there is nothing really there. And so you have to dig harder for those insights and have that base idea of what's going on in the industry. Another really interesting one is, even in precious metals, a lot of coverage on gold, but there's not so much on platinum, the metal platinum. So we do the work in those areas. There's not good research off the shelf. There's not good daily analysis of what's going on, news and events and change. We don't get 100 emails a day on these smaller areas like we may on what's going on in social media or electric vehicles. And it just provides great alpha opportunities. So we do the work ourselves. Often the drivers come from understanding those larger industries. So upstream or downstream of those industries, like the examples I just gave, we target into the most interesting subsectors of those industries to find really good stories, and often enough, they're actually underappreciated by the market, so we can invest.
Some of those coverage stats are pretty astounding, aren't they? Imagine half the market just not being covered at all. In the large cap space, that's just completely unheard of. And that's what creates both the challenges, but also the opportunities. So let's dive into how our industry-led research approach gives us an edge in this space. And you started to touch on it already. And also, where information is limited, what gives you the confidence to act with conviction?
So look, I do think it gives us a real advantage, that industry-led research process. I'd start by saying the process results in a deep understanding of large competitors in industries. If we think about what that means for the small and mid-cap companies, it gives us a lot of perspective. So for example, if you're investing in software and you don't have a really good idea of what Microsoft's doing or some of the other larger players, you're taking a hell of a lot more risk. If you're looking at retail, even online, a store-based retailer, and you're not following what Amazon's doing closely in that category, you're taking a lot more risk, or what Walmart's doing. That really helps our understanding and takes us out of the vacuum of looking at an individual company. And certainly the sell side coverage, and I think a lot of fund management coverage in this space is really focused on the company, because you have a smaller team and you really have to focus on researching stocks. So we have a large investment team of over 30 professionals really focused on industries. And so the core advantage is having that broad platform and uncovering the best opportunities and being, in terms of within a sector, not starting with, this looks like an interesting idea, actually having views around what's changing in the world and going and hunting for those ideas that will benefit from that change is more productive, more efficient, and results in better outcomes.
James, let's bring that process to life. Can you take us through an example of how the industry-led research process works and where it has identified winners across that market cap spectrum?
Basically the whole portfolio, I would say, is something I could talk about that is really interesting in terms of what's going on, and often we'll own more than one stock that has exposure to the change. So I'd probably talk about the TV industry. And we've spent a lot of time on TV over the years, and we know that there's been a big shift in time spent towards streaming. Streaming is now around half time spent in people's homes of watching TV, with the other half sort of being traditional broadcast TV or pay TV. The most interesting fact here, though, is only about 10% of advertising spend for the TV sector is spent on streaming TV ads. And so what's changing? So over the last 12 months, 3 major streaming networks, Disney, Netflix, and Amazon, have developed and launched ad-supported products. They didn't have those products a year ago. It was all subscription. So whilst their subscription revenues might be somewhat mature, and they're growing fast in ad-supported product. So there's a clear catalyst here for that time spent on streaming, or the advertising revenue on streaming, to catch up to its natural share of the TV market. We think the process would target how can we apply advertising. If we try to look at that industry in another way, we'll say that 10% of ad spend versus 50% is a 5x increase in ad revenues. That's pretty interesting. Again, looking at it another way, time spent is really good for all media, actually, to think about the value of advertising over time. And time spent on streaming TV is about 1.5 times the amount of time spent on social media. And then we look at the advertising spend, and it's 3% of digital advertising spend. So huge opportunities there for time to catch up as well, just to other digital ad formats if we look at it as a digital ad format rather than a TV ad format. So whether we're comparing to TV or we're comparing to digital ads, a lot of value uplift. And then the advertising price, which is perhaps the most interesting piece. These TV ads on streaming are priced roughly in line, slightly above traditional TV ads, and that's a 60% discount to a social media ad. So think about what a social media ad is. You flick through it for a few seconds, maybe 1 second. But a TV ad is 30 seconds, generally where you're very engaged. Theoretically, it's a much better ad, a more valuable ad. So why is it being sold at less than half the price? And the reason is personalization and data. So we all know that Facebook has personalized social media ads exceptionally well, and that is coming to TV with smart TV. So we know your credit card number from your operating system. We know your postcode. We know whether you like gardening or home renovations, and so on and so forth. And so what you're likely to see over the next decade is your TV ads becoming more and more about things that are interesting to you and more targeted to you and more relevant to you, and less about things that apply to everyone. So TV has traditionally been 80% of the spend of the top 300 companies in the world, and you get things that apply to everyone. So you'll see an ad for a car. You'll see an ad for toothpaste. You'll see an ad for things that you use in everyday life for cooking or whatever it may be. And what you'll see in future is if you've got a sore neck or you're particularly, you're a green thumb, you'll see things that are appropriate for gardening in your postcode at the right time of the year. And that personalization will move in sophistication, towards where social media is. And so those ad unit prices will grow significantly. So we pull all this together. We get an industry, let's call it a subsector of the TV industry, that we're pretty confident can grow at 20% plus for the next decade.
So that's the industry work. And then what stocks did that lead you to for the SMIDs Fund?
Yeah, so that's led us to Magnite and Roku. So Magnite is the smaller position in the fund of the two, but it supplies the software that serves the personalized ads that you can see on the streaming TV operating systems to 29 of the top 30 streaming services. The only one it doesn't supply to is YouTube, which Google uses their own technology. And the way ads are bought, there is a bit of a network effect in this place. So, Amazon uses their software and used it to do a deal actually just yesterday yesterday of the day of recording at least, with Roku, which is the larger position that we own, which is the TV operating system in the US. So think about this as a bit like the cable channel, where the media company that's providing the content that you're watching, the channel that you're watching on streaming, will allocate 15 or 20% of their ad units traditionally to the pay TV provider, now to the TV operating system provider. So they get a basically a straight cut through take rate on advertising spend on the operating system. And then we sort of go through and think about what this is. Well, it's the leading operating system in the US. So over half US households have a Roku TV in their house. This is a great business. So go back to operating systems in general. They end up consolidating into a monopoly or a duopoly. So the PC was a monopoly with Windows, and the mobile phone became a duopoly with Android and iOS from Apple. These are really influential businesses. So we think about on your Android phone or Apple phone, the influence of how you spend your time is extreme based on the operating system. And you can just tell the difference by looking at the difference in behaviors between the two users. So if you're an Apple user, you're much less likely to use Chrome as your browser than you are if you're an Android user, where you almost certainly use Chrome as your browser. Likewise, your map. Most Apple users it's only a slight majority, but it is a majority use Apple Maps over Google Maps, whereas everyone on Google uses Google Maps, right? And so if we think about the industry here, just in the US alone, we're talking 70 billion of advertising revenue, another 150 billion of subscription revenue. If I can shift 10% of the time spent from one service to another, the value for the providers in terms of the advertising revenue, subscription revenue they can collect is extreme. And we think there's a lot of evidence that Roku, as the operating system, is really influencing where users spend their time and what channels they're watching. And that part of the monetization's barely come through. So we've got this huge dynamic in terms of growing advertising revenue, influencing time spent on TV, perhaps becoming the largest influence on how people spend their time on TV in the US, and a really nice long-term growth cycle. And in terms of being underappreciated, we think the stock's trading at roughly 15 times PE on its mid-cycle kind of margin profile, with that decade of strong growth to come. So the expected returns are excellent, and I think it's a really good example about how we've got a really huge industry, one of the largest industries in the world. And we've been able to zoom in onto, the most exciting subpart of that industry and find it a good valuation for investors in the fund. And that's really what we're doing on repeat. We're zooming into the most exciting subsector of a broad sector, and where the change is large and unrecognized.
And look, the performance of the fund shows that this industry-led approach, coupled with a well-resourced investment team, works, doesn't it? I mean, compliance may hate me for this, but let's look at performance. Since launching in November 22, the Antipodes Global SMIDs Fund has been the top performer in its peer group, delivering 26% per annum in returns after fees to 31st of May 2025, and delivering over 13% per annum in alpha. Now, of course, past performance doesn't reliably indicate future performance, but what is striking is that this alpha has come across almost all regions and sectors with very strong risk-adjusted returns. The fund has captured 138% of up markets, while limiting downside to just 46%, which is impressive for a long-only strategy. This is part of the Antipodes DNA, isn't it? To invest with a capital preservation mindset. So Can you walk us through your approach to risk management and how you've been able to deliver such effective downside protection, particularly in a global SMID context where, you've referred to as being a more volatile part of the market?
Look, that downside capture being in the 40s, below 50% is the result of the Antipodes process. We're extremely risk focused, and you can see that in the Global Value Fund and the Global Long Short Fund, where downside capture is much lower than the market, and you get a sharp ratio above 1 in both of those products as well. So just to run through the process in simple terms, it's the same process here that we run with in terms of managing the portfolio. So at the individual stock level, once we've done that research, we really break it down to having ideas that have multiple ways of winning. We don't want an investment case to hang on one thread. And we find if we have lots of ways we can win, it really reduces the risk because it's more likely that something will happen. And then we think about margin of error. And so a bigger position would need to have a low margin of error. So margin of error is how wrong can I be? And so if I'm to explain that in simple terms, if I'm thinking about investing in a grocery retailer, in a good year it might grow 5%, in a bad year it might grow 2%. So it's got a very low margin of error.
So it's really thinking about that range of outcomes in that investment case.
That's right. And whereas if I'm trying to think about the volume of usage on one particular AI model provider in 5 years' time,
Wide range of
outcomes. So stock level qualitatively is multiple ways of winning, and thinking about how wrong we can be, that margin of error. And then, of course, we want upside on the expected return. So margin of safety, we're looking for strong upside and strong return potential for that given level of risk. And then we put it together in a portfolio. And the portfolio construction, the goal is really as many uncorrelated sources of strong alpha as possible. So we do a lot of work to understand the correlations in the portfolio and looking to have those less correlated support sources. The portfolio is 60 stocks. It's not a concentrated, I would say that is concentrated, but it's not a highly concentrated 15 or 20 stock portfolio where you're getting really, your returns are hanging on stock picks in a really small number of companies. It would be significantly more volatile, and in this asset class is already more volatile than large cap stocks. And so I think that's one of the advantages of active management here, is that it is more volatile and you can take advantage of those price swings. Often we'll see things fall substantially for no good reason or potentially rise, and you should be taking advantage of selling into the strength or buying into the weakness, and that's certainly helped returns. But broadly, we want there is more margin of error in smaller companies, and so we want to take less risk, and so that's how we've kept the down market capture really, really strong, and that industry knowledge has kept the upside capture obviously and the total returns very strong. So, talking about how has that delivered alpha for investors, you ran through the numbers, but I think it's the consistency is important. So we've seen strong alpha in, let's call it, the 3 major sub-geographies of the world. So in the US, in Europe, and in the rest of the world, including emerging markets. And then on a sector basis, we're seeing it in 10 out of 11 gig sectors. Hopefully we can make it 11 out of 11, but 10 out of 11. So what we're doing is we're not picking sectors. We're managing with a respect for the opportunity set in this part of the market as our base positioning. And we're going into each of those sectors and picking out, like that TV media example, we're going in there and trying to pick out the best ideas within that sector is the philosophy. And so that's made the return profile of the fund over the 2.5 years since we launched a lot more consistent, a lot less episodic, and a lot more defensive in down markets. And so, look, the last thing, I think we've already spoken about it, but it's a stock picking engine is the reason we do the industry research. Really, the fund hasn't had any major allocation tailwinds or headwinds in terms of positioning from a sector or geographic basis. The alpha delivered today is really on stock selection. And so we're trying to deliver lots of those good ideas, like I spoke about before, in industry change stories, and put them all together.
So, James, I know you've taken us through Roku already, but To wrap this interview up, can you leave us with one more big idea? Is there a particular company or another segment of the market that you're especially excited about right now?
Yeah, look, I think I'll go to one of our largest positions, top 5 position that I think is actually it's quite a defensive business and a defensive industry. So I'll talk about Brookdale Senior Living, which is one of the largest pure play senior housing operators in the US. So think about senior housing as somewhere that you might reside in your later years. So you might have lived in a retirement village and then you might move to senior housing. And really this sits at the core of a really powerful long-term structural demographic trend, the silver tsunami. So the first baby boomers turn 80 this year. That kicks off a multi-decade wave of aging Americans, but it kicks it off really quickly. The number of people in that age cohort rises rapidly over the next few years. In fact, by 2031, we expect the number of seniors and the demand entering these facilities to nearly double from 2025. So we're hitting this steep part of the growth curve for the industry. So when we take a step back and we think about what's happened in the industry, everyone knew this boom was coming. And so 2015 to March 2020, there was a wave of new supply that hit the market. And it culminated in oversupply probably by 2019, to be honest. And then in 2020, we had COVID hit, which saw occupancy rates fall reasonably significantly in the sector, unfortunately. And so since that period caused falling occupancy, and at the same time, building costs and construction costs have increased by, let's call it 40% since then. So we had a period where you had low occupancy and no new supply. And so that's continued to be the case with most of the market operating somewhere in the 80% occupancy range at the moment, mid-80s, let's call it, low to mid-80s. We fell into the 70s during COVID, and historically we would expect to be closer to 90%. And so the result is a big shortage of beds in the sector, just as demand is about to take off. And so Brookdale has around 3% of the beds, senior housing beds in the US, and it's very well positioned to benefit from this trend. I'd say competitors, or larger competitors, have focused on occupancy. Brookdale's focused more on profitability, offering less discounts. So it has a lower occupancy at the moment in the low 80s, trending towards the mid 80s, I should say. But it generates higher revenue per bed. Now, part of that is the quality of the portfolio, but part of it is it hasn't really discounted. It's focused on profitability. So as we get more occupancy, profitability really inflects for this industry. It's relatively fixed cost from 80% occupancy through, say, 96% occupancy. If you think about 96 as peak occupancy, there's not really a large change in cost. So bringing it back to the investment case, we've got that great demand dynamic, we've got that great supply dynamic, and we've got a company here that's profitability is on lower occupancy. We fast forward to where we think occupancy will be, which we put in a base case of 90%, which may be too low, and we think about a 7% cap rate. So they own the majority of the real estate as well. So it's a real estate play. So cap rate is a reasonable way to think about it, and really the industry standard for thinking about it. 7% cap rate, 90% occupancy. We more than triple our money in the stock. You can think about this in other ways as well. The company was part of that build and does have reasonable leverage. It's all termed out, and we think it's very low risk when we look at the structure of that. In fact, some of it's got government guarantees because the government's been very focused on supporting the sector. But the stock's trading at around $200,000 a bed. And if we were to take it to replacement cost, which is near $350,000 a bed, we actually end up at magically that 7% cap rate or 90% occupancy, which roughly can allow us to triple our money in the stock. So really defensive industry, really predictable tailwinds that are coming. You can't change demographics. Reasonable affordability, when we look into the affordability to hit these demand numbers that we're suggesting that are coming, and no new supply. So it's just a fantastic opportunity. It takes advantage of a major industry secular trend, but where there's been some disruption to what's happening in the industry that's caused the supply side to actually also be tight into that strong demand and historical numbers being extrapolated on the financials of a company, where we think the financials are about to drastically change over the next few years.
I love ending the podcast on a strong recommendation, especially one that has both that supply side and demand side characteristics that those constraints. Thanks, James. Some great insights there, as always. Always great to have you on the podcast.
Thanks, Alison.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.